Ukraine is poised to finalize a significant agreement with the United States, granting access to its rare minerals in exchange for continued U.S. military support amid its ongoing conflict with Russia. Ukrainian Prime Minister Denis Shmyhal emphasized the strategic importance of this deal, which aims to establish a joint investment partnership for Ukraine's development and restoration. The agreement focuses on Ukraine's deposits of critical materials like titanium, uranium, lithium, graphite, and manganese, which are vital for aerospace, nuclear power, and electric vehicle batteries. This deal, pending ratification by the Ukrainian parliament, seeks to balance interests between the two nations, ensuring that new U.S. military aid is part of the investment without conflicting with Ukraine's aspirations for European Union membership. The negotiations occur against a backdrop of strained U.S.-Ukraine relations and a complex geopolitical landscape. U.S. President Donald Trump has tied access to these minerals to continued American support, framing it as a reimbursement for past aid. The U.S. has expressed a desire for expedited peace negotiations, with Secretary of State Marco Rubio urging both Ukraine and Russia to propose concrete solutions to end the conflict. Meanwhile, Russia remains a significant obstacle, with President Vladimir Putin insisting on addressing several issues before agreeing to a ceasefire. The outcome of these negotiations could have profound implications for global supply chains of rare minerals, U.S. foreign policy, and the broader geopolitical balance in Eastern Europe.
The Trump Organization has secured a new foreign deal for a luxury golf resort in Qatar, signaling a shift from its previous stance of avoiding new overseas ventures during Donald Trump's first presidential term. This development marks the first international deal for the company since Trump took office, featuring a Trump-branded golf course and beachside villas constructed by a Saudi Arabian firm. The move highlights the company's aggressive pursuit of foreign business opportunities despite potential conflicts of interest, as President Trump's policies could be perceived as benefiting his personal financial interests. In other significant economic news, the U.S. economy contracted by 0.3% in the first quarter of 2025, marking the first decline in 3 years. This downturn is attributed to a surge in imports as U.S. companies rushed to acquire foreign goods ahead of impending tariffs imposed by President Trump. These tariffs form part of a broader trade war strategy, which Trump argues will impact China more severely than the U.S. Despite reassurances from the administration, the contraction has raised concerns about potential recessionary pressures, with consumer spending also slowing sharply during this period. The economic climate remains tense as businesses and consumers adjust to the evolving trade policies.
The law offices of Frank R. Cruz has announced a securities fraud investigation into Bancorp Inc., EGBN, following the company's disappointing first quarter 2025 financial results. Bancorp reported a significant drop in net income to $1.7 million from $15.3 million in the previous quarter. This decline was attributed to a $14.1 million increase in provision expenses, a $5.1 million decrease in net interest income, and a $0.9 million rise in non-interest expenses. The company highlighted valuation risks in its office portfolio as a primary concern, impacting its provision for credit losses. Consequently, Eagle's stock price plummeted by 11.4%, closing at $18.78 per share on April 24, 2025. The investigation seeks to determine if Bancorp potentially violated federal securities laws, which may have contributed to investor losses. The significant drop in stock value reflects investor concerns about the company's financial health and its exposure to valuation risks in the office portfolio. This development could potentially lead to legal actions from affected investors seeking to recover losses. The unfolding situation highlights the importance of closely monitoring corporate financial disclosures and the potential legal ramifications of significant deviations from expected financial performance.
Amazon.com Inc. (AMZN) shares are experiencing an uplift in after-hours trading following the announcement of a significant $4 billion investment aimed at enhancing its rural delivery network across the United States by 2026. This strategic initiative is set to expand Amazon's reach in less densely populated areas, potentially increasing the company's logistical capabilities with over 200 new delivery stations and creating more than 100,000 jobs. The expansion is expected to enable Amazon to deliver an additional billion packages annually across 13,000 zip codes, covering an area equivalent to the combined size of Alaska, California, and Texas. This move underscores Amazon's commitment to improving delivery efficiency and customer service in rural markets, which could bolster its competitive edge in the e-commerce sector. The positive market reaction to Amazon's announcement is further supported by favorable performances from tech giants Microsoft and Meta platforms. Strong results in Microsoft's Azure and cloud services, along with Meta's advancements in AI investments, suggest potential growth for Amazon Web Services, AWS, Amazon's cloud computing arm. Investors are also anticipating Amazon's upcoming earnings report, with analysts projecting earnings of $1.36 per share on revenues of $154.92 billion. The after-hours trading saw Amazon's stock rise by 2.81%, reflecting investor optimism towards the company's strategic investments and the broader tech sector's robust performance.
Napco Security Technologies, Inc., NSSC, is currently under investigation by the law offices of Frank R. Cruz for potential violations of federal securities laws. This follows the company's release of its second quarter fiscal 2025 financial results, which reported a significant reduction in hardware sales attributed to decreased orders from two major distributors. As a result of this announcement, Napco's stock price plummeted by 26.6%, closing at $26.93 per share, causing considerable financial losses for investors. The investigation is particularly focused on Napco's withdrawal of its long-term target of a 45% EBITDA margin, which the company now doubts it can achieve by the end of fiscal 2026. This development has raised concerns among investors and analysts regarding the company's future profitability and strategic direction. The substantial drop in stock price reflects growing market skepticism and could potentially lead to further legal and financial repercussions for Napco. Investors who have incurred losses are encouraged to contact the law firm to explore potential claims for recovery.
The Group of 30, an independent global consultative group, has recommended that the Federal Reserve prioritize its 2% inflation target over its unemployment objective. This recommendation suggests a shift from the Fed's recent bias toward maximizing employment, which has been its focus for nearly 5 years. William C. Dudley, chair of the G30 Working Group on the 2025 Federal Reserve Monetary Policy Framework Review, emphasized the need for the central bank to clearly communicate how it will manage trade-offs between employment and inflation when these objectives conflict. This guidance comes as the Federal Reserve is conducting a formal review of its monetary policy approach, following the high inflation that emerged after its strategy update in 2020 during the pandemic. The Group of 30's report also advises that the Federal Reserve publish its staff forecasts after each Federal Open Market Committee (FOMC) meeting. Carolyn A. Wilkins, a project advisor for the G30 Working Group, argues that this transparency would enhance public and market understanding of the economic outlook and the Fed's policy decisions. The Fed's ongoing review, expected to conclude by late summer, aims to reassess its strategies in light of recent economic challenges. This proposed shift in focus could influence market sentiment and investor expectations, potentially affecting interest rates and stock market dynamics as the Fed navigates the balance between curbing inflation and supporting employment.
In a volatile trading session, Wall Street demonstrated resilience as U.S. stocks rebounded from early losses to close with mixed results. The S&P 500 recorded a slight gain of 0.1%, marking its seventh consecutive day of increases, while the Dow Jones Industrial Average rose 0.3%. The Nasdaq Composite experienced a minor decline of 0.1%. This market behavior reflects ongoing uncertainties driven by disappointing GDP data, which showed a 0.3% contraction in the first quarter, and President Donald Trump's trade policies, which have heightened fears of a potential recession and stagflation, a scenario of stagnant growth coupled with high inflation. Despite these concerns, stronger-than-expected consumer spending data in March provided some relief. Corporate earnings contributed to market volatility, with Starbucks shares dropping 5.7% due to halved quarterly profits, while Super Microcomputer shares fell 12% following a weak earnings forecast. Conversely, Booking Holdings stock rose by 3.9% amidst increased revenues, and Woolworths and Kohl's reported solid sales growth, boosting their share prices. In commodities, Brent crude dropped 1.7% amid potential increased production by OPEC+, reflecting broader economic uncertainties. The Australian Securities Exchange, ASX, is set to open lower, influenced by Wall Street's volatility and ongoing trade tensions. However, the ASX 200 managed a 0.2% gain, driven by tech and consumer sectors, despite significant losses in mining and energy stocks. Woolworths and Kohl's reported notable sales growth, while Platinum Asset Management surged on merger talks. Globally, market sentiment remains fragile, with analysts anticipating challenges ahead due to trade policies and their economic implications. Investors continue to navigate this turbulent landscape, balancing cautious optimism from corporate earnings against broader economic uncertainties.
Homebuilders in the U.S. are increasingly targeting first-time buyers, particularly millennials and Gen Z, with innovative financing solutions as they navigate high interest rates and escalating home prices. Companies like D.R. Horton and Pulte Group are collaborating with mortgage firms and banks to offer tools such as interest rate buy-down programs, forward commitments, and 40-year mortgages. These strategies aim to make homeownership more affordable, with D.R. Horton reporting that over half of their new home deliveries cater to first-time buyers. Despite a challenging economic landscape, the company posted $7.2 billion in home sales revenue for the first quarter, highlighting the effectiveness of these initiatives. In addition to these national efforts, regional programs such as the Work Here, Live Here initiative in Mississippi County, Arkansas, are making strides in addressing housing affordability. This program, supported by local steel producers and banks, offers substantial financial assistance to employees purchasing homes, contributing to a significant drop in the county's unemployment rate. The broader trend indicates a strategic shift among home builders to not only manage excess inventory, but also to stimulate demand in a volatile housing market. As interest rates for 30-year mortgages approach 7%. These financing innovations are crucial in maintaining market momentum and addressing the affordability challenges faced by new homebuyers.
Mexico's state-owned energy company Pemex reported a net loss of 43.3 billion pesos, $2.12 billion, for the first quarter of 2025, primarily due to a decline in crude and condensate production and foreign exchange losses. Production fell by 11.3% to 1.62 million barrels per day, BPD, missing the government's target of 1.8 million BPD. This shortfall is attributed to the depletion of mature wells and delays in new well completions, alongside a 5% reduction in refinery processing. Revenue decreased by 2.5% to 395.59 billion pesos, reflecting reduced crude oil sales. Pemex, the world's most indebted energy company, saw its debt rise to $101.1 billion, despite receiving 80 billion pesos in government support to manage its liabilities. The company's debts to suppliers have also increased to $19.9 billion. In response, Pemex plans to boost production through joint ventures with private firms, maintaining at least a 40% stake as part of its strategy to stabilize financial and operational performance. President Claudia Sheinbaum has emphasized increasing domestic production to reduce reliance on fuel imports. But the challenges posed by declining mature fields and insufficient new discoveries remain significant. Coordination with the Finance Ministry is deemed crucial for Pemex, in managing its financial and commercial obligations and achieving a sustainable hydrocarbon production outlook.
The Bank of Japan, BOJ, has decided to maintain its current interest rate at 0.5%, while significantly lowering its economic growth forecasts due to the adverse effects of U.S. tariffs on exports. The revised projections now estimate a growth rate of 0.5% for the fiscal year ending March 2026, down from a previous forecast of 1.1%, and 0.7% for the following year, reduced from 1.0%. These adjustments reflect the uncertainties introduced by U.S. trade policies under President Donald Trump, which have contributed to a broader downgrading of global growth forecasts by the International Monetary Fund, IMF. Despite these challenges, the BOJ remains optimistic about achieving its 2% inflation target in the coming years, supported by anticipated domestic wage growth exceeding 5% in future labor negotiations. The central bank expects that underlying consumer inflation will reach the target by the latter half of fiscal 2026, although this marks a delay from previous expectations. In response to the BOJ's announcement, Japanese government bond yields and the yen have declined as market participants adjust to the revised economic outlook. BOJ Governor Kazuo Ueda emphasized the importance of cautious monitoring of trade negotiations and global supply chain stability, acknowledging the heightened uncertainty. Nevertheless, the BOJ maintains a cautiously optimistic long-term view, anticipating a resurgence in exports, output, and capital expenditure once the current slowdown passes and global economic conditions stabilize.